Here at ABP Live Startup Conclave, we've got you covered. Next up, ladies and gentlemen, I will host a fireside chat on the foundations of successful fundraising. My guest is Mr. Vikram Gupta, the founder and managing partner of Ivy Cap Ventures. Sir, may I please request you to join us on stage? Ivy Cap Ventures, as we all know, is a leading venture capital firm that focuses on investing in high growth companies across various sectors. With over 2 decades of experience in the investment and entrepreneurial space, Mr. Gupta has played a pivotal role in fostering innovation and nurturing early-stage startups. His expertise in venture capital, combined with his passion for supporting entrepreneurs, has earned him a reputation as a prominent figure in the Indian startup ecosystem. Like I said, I'll be hosting this fireside chat. Can I have a round of applause for my guest here? Thank you. So, like I said, पैसा कहाँ से आएगा? You know, that's the biggest worry for anyone who has an innovative idea, is keen on jumping into the market, but doesn't know how to go about raising the funds. So, right for a beginner, you know, somebody who's a veteran in the market, what is your advice? How to go about the funding project for their startup?
You know, first of all, it's very important. Thank you so much for having me in this program. I think the first and the foremost thing is for the entrepreneurs. I think we just saw the panel discussion. I think the vision is very important for an entrepreneur. Many times the entrepreneurs think that fundraising is the end of the game. Fundraising is actually only part of the game, right? So you have to actually come down to your fund requirement rather than start with how much funds you need to raise.
All right.
So your vision has to be very clear. You need to understand where you're headed, what problem you're trying to solve, how you're going to solve it, what's the motivation for solving it, and then come down to what support system you need, which would include the right team, the right support system, and funds. So you derive your fund requirement based on your overall objectives and other things. And then you take your story to the people who not only have the funds, but also who could be your right partners. Because if you take money from a wrong partner, the chances are that you may get derailed from your overall plan.
Okay.
So raising money from the right people is also very, very important.
You know, I was going to ask you this question a little later, but now that you've already touched upon this topic, I want to understand from you, for a startup, how do they decide which type of funding is appropriate? Where to go, angel investors, venture capital, crowdfunding, what is the best method for your kind of startup? How to determine that?
So a business obviously goes through various phases, right? So there is a phase where the entrepreneur comes up with the idea. You know, think about, you know, many times it comes from their personal experience. So they faced a problem and they start thinking why this problem is there, why this problem is not being solved. That goes into then thinking, you know, maybe there's a business opportunity here. And then, you know, you start thinking of what team is required. You may start working on an initial set of people, you know, with the idea. You build a co-founding team. And then you start thinking of a seed round of funding. Usually your first round happens to people you already know. So that's called friends, family, and fools round. So that actually happens only because people don't necessarily know what you're working on. People know that you are doing something, at least my money is safe, so people give you the money. From there, if you actually start gaining some traction, the problem actually starts getting solved in a very limited way. You go to organized angels and seed investors. So that's when you go and try and raise professional seed capital or angel capital.
Okay.
With that, you further build your product market fit. And then you go to the market to raise venture capital. So venture capital is the first time when an institutional investor comes into play, because venture capital means third-party capital. So, you know, depending on the stage of your startup, your nature of investors will be different. But at each of the stage, your type of investors could be different. For example, in angel, if you pick up money from people who do not understand your business, but somehow they're just trying to extract their pound of flesh by just somehow trying to extract a lot of stake in the company, it may not necessarily help in the next round. So you need to make sure that you're raising capital from the right investors, right from the seed stage. And then at the venture capital stage, you have to make sure that the VCs have the right network, right portfolio where they can actually bring value from their portfolio. And the LPs behind the VCs, the investors who've invested in the VC fund,
Right.
even they can actually contribute. So many times the founders don't even ask the question, who are the investors backing the VCs?
Okay.
So I think these are some of the important questions. Just like an investor does a due diligence on the startup should do due diligence on the investors and find a lot about them. These days, the number of investors increased quite substantially in the market. So therefore, the entrepreneurs do have a little bit more luxury to actually go do the research and meet all the investors before they actually make their decision.
Okay, again, I'm just curious to know here. Maybe you can enlighten those of us who don't know. Where has this term angel investors come from? Angel because they come like a masiha, बिचारे startups को पैसा देने के लिए तैयार हो जाते हैं.
Yeah, angels are called angels and ventures are called vultures. So it's very interesting actually. See, the reason they are called angels is at that stage, it's really, there is no proof which is there for the business, right? It's all about a story. It's all about just the team they look at. It's all about just an idea at that stage. So they are coming as angels to the founders because otherwise, they may not necessarily be able to even take off. So it's like a take-off money. So angels, word comes from there.
Right. So, Mr. Gupta, now let's go step by step. If I'm a startup and I have already roped in friends, family, fools, I've got an angel also. Going the professional way now, what should be the right pitch when I approach an investor? What are the key elements of a pitch that have to be there for you to convince any investor to come forward and invest money in your venture?
So the first thing you want to make sure, obviously this whole thing is a story. So it's a lot about storytelling. So, a good entrepreneur and a good fundraiser is a very good storyteller. And the storytelling is a lot about what problem you're solving and why you're solving that problem. And then you have to be able to justify that, this problem is so large that the number of people who will benefit by solving this problem is going to be substantially large. And then you prove that, the willingness and ability of people to pay for solving that problem is also very large, which then translates into the market size of the opportunity. And typically, VCs will look at investments when the market size is substantially large. So when we look at an opportunity, we say that can this business, it may not be 5 years, 10 years, but eventually, can this business be $1 billion in revenues? So we look at that kind of a size when the founders are telling us the story. Then it comes to the team. Do they have the right mix of the people? Do they have the right incentive model? And the why part is very important, why they're doing it. Are they doing it genuinely to solve a problem?
Right.
Or they're just doing it because their neighbor raised much more capital, and therefore they need to prove to them that they can raise more capital. So I think that also happens a lot. So you need to understand the intent. And of course, then you need to understand whether they'll use the capital judiciously to get there. So the capital efficiency matters a lot. So I think it's a combination of these three things. And then of course, there's a lot more detailing behind that, but these are the three main components that need to be addressed.
I'm sure we can have a PowerPoint presentation on the right pitch and what are the key elements, but that's for another day. But, I'm very interested in knowing that usually when there's an innovative idea, you do get the first mover advantage. For example, let's talk about the blue tea. Mr. Nitesh and his team got the first mover advantage. Their idea was innovative. They were great storytellers. So it became a successful product and is doing well in the market. But there are people who would say that, okay, now that they have the blue tea, let me try something like a pink tea, and maybe, my idea will also resonate with the consumer. So when the person is second mover or third mover in the industry, how difficult is it for them to get funds?
I don't necessarily believe that first movers always make it big. We know that Yahoo came before Google.
Yeah.
And Google really understood the real, opportunity and executed much better. And there are many such examples where the second mover will move in such a way that people wouldn't even know who the first mover was, right? So I think it's a lot about, the execution. In fact, the first mover also typically, if you make mistakes, you've actually given up the idea, but you've not executed well. So if you're the first mover, you have to make sure that you execute well as well. So in that sense, I think it's important that if you're the first mover and you execute well, I think then you will create huge value.
Right.
So, so I think for us, we have also invested in the second, number rank in the market. For example, we invested in Purple as compared to Nykaa.
Okay.
Right. So similarly, we invested in Clovia, which is in lingerie, as compared to Pretty Secrets. And the second movers actually created far more value from an investor's perspective than the first mover would have. Because the first mover also sometimes will ask for a much higher valuation. And the second mover may execute better than the first mover and may actually come with a more realistic valuation. So from an investor perspective, I'm okay to even look at somebody who's actually looking at a market leader and saying, hey, I know this market leader is moving well, but this is how I'm different, and this is how I'm going to be more nimble, more capital efficient. And if the story makes sense, you look at it.
Yeah, I think that's a great lesson for all the aspiring, young entrepreneurs out here, that it's never too late. If you have a great idea, a vision, and you know how you will execute it, you can always get investors. That's a very important thing to know. Now, let's talk about some of the common mistakes that some founders or young entrepreneurs make when they pitch to investors. Can you please guide them? What are those mistakes and how to avoid them?
Yeah, that's a very good question, actually. In fact, quite a few mistakes, not just in pitching. I think many times they make a mistake in becoming so passionate about the problem they're trying to solve that they become so narrow in their thinking that they don't want to think beyond. In fact, many times, one of the other mistakes founders make is that, just because they heard no first 3-4 times, they think that their idea doesn't have value. In fact, I believe that if you should ideally get at least 20-30 no's before you get to the real, money that you're raising. Why? Because every meeting you have with the investor is a huge learning experience. In fact, if you've done 20 meetings, in the 21st meeting, the chances are that you know more than the investor.
Wow.
Because you know the kind of questions that are coming, and you keep refining your answer, your solution, and you keep becoming smarter and smarter. So one of the common mistakes that is like, you lose heart just because, your first 10 investors said no to you. As long as you believe in yourself, in the problem you're solving, and as long as you're willing to correct yourself over a period of time, you will do it. You'll make it. And then plenty of examples. People, who actually were rejected 70, 80 times and are decacons today, right? So there are many such examples.
Yeah.
So I think, and of course, there could be storytelling also may require certain reforms in terms of how people tell their stories. Many times people go to the meeting thinking that we will pitch based on we know what these people want to hear, so let me tell them what they want to hear. Well, that's important, but you don't want to lose your identity or your story or what your passion and the problem you're solving just in order to, say what the investor wants to hear. For example, let's say if you're raising just 10 crores and you're going to an investor who doesn't invest less than 30 crores. So you start pitching a story in a way that your business actually requires 30 crores. So it becomes very visible that, you actually don't need 30 crores. So you can actually pitch even a 10 crores to a 30 crore investor, because you never know, the 30 crore investor might make an exception and say, your story is so good that I'm willing to bring down my ticket size to invest in you.
Be authentic, basically. You be
authentic.
Realistic in your idea. So, I want to understand from you, in your vast experience, have you ever had this experience of telling someone who's come to you with a very passionate idea, a very good, gap in the market, but is not a great storyteller? And you can see that, and you want to help that person. Has it happened? Can you give some examples?
Yeah. It does happen many times. Our fund thesis is that we are supported by the IIT alumni ecosystem. So naturally, our deal flow comes a lot from the IIT ecosystem, right? So part of our profits go back as endowment to the IITs. So any deal that originates in the IIT ecosystem comes to us. Now, not all IITians are very good storytellers, right? I mean, they do have good products, they have good team, but they are not necessarily good storytellers in the beginning, especially when they're raising their Series A at the stage when we are investing. So we try to understand what the gaps are. For example, we recently invested in a company where we realized that great entrepreneur, great product, great market opportunity, but doesn't have fundraising capability. He's not able to articulate his story well. So what we then realized is that because everything seems to be good, this guy needs a co-founder who's actually a good storyteller.
Wow, okay.
So we brought another co-founder from our own ecosystem who's a good storyteller. Said, why don't you come with this guy? And you guys work it out. So that one person is a good storyteller and the other is the guy who's the product guy and the solutions guy.
Yeah.
It works very well.
And now I know the story behind co-founders.
Exactly.
We see so many co-founders associated with so many startups. I think that's a great idea.
Yeah.
And that lends superb support to someone who has a original idea and needs a bit of hand-holding. So that works well. Now, once the finances are arranged, the funds are arranged, an investor is convinced, how do you ensure that the person that, has got your investment stays disciplined in the investment, and how crucial is that?
Again, very good question, Preeti. I think this is something which obviously there's been a lot of learnings. Many times, if you give more money than required, you will see a substantial change in behavior in the founding team. We have examples like housing.com, very small revenues, they got $90 million from SoftBank, and all of a sudden, they had to burn that money, and then they just started burning in different places. And there are many such examples. There was a time when people were getting $100 million checks when they didn't even need that money. So, basic discipline, first of all, in terms of making sure that you use your capital very efficiently. Even if you have more capital than you need sitting with you. And many times, there will be investors who have deployment pressure and they end up giving you more capital. I think the founders have to stay very focused, very, very, disciplined, and very transparent, and people who don't follow this usually lose that track. And when they lose that track, it's very hard to bring them back. And we have various failure examples that we can see,
True.
right? So I think the role of VC plays there is even before we make the investment, we first of all assess whether the founders are ethical, they are willing to, be coached, because there's a lot of coaching required. Many times they don't know these things.
Right.
So we bring a lot of mentorship, a lot of support, a lot of coaching in terms of how they should, manage their money, how they should build a team, how they should allocate their money across different areas. So all those things we actually spend a lot of time on. So as long as the team is willing to learn, I think we want to work with them because that's the role that a VC plays.
But if somebody is, let's say, incorrigible, it's absolutely difficult to bring them back on track. How does an investor decide that this is time to now snap ties and we can't go forward with this? And is there a warning system? Is there a step-by-step approach to that also?
We do obviously monthly MIS reports, and in cases, we assess upfront whether this particular team would require weekly follow-ups or monthly follow-ups or quarterly follow-ups. Now, if we know that, they need coaching on a weekly basis, we'll work with them on a weekly basis. In certain cases, even on a daily basis. But, very rarely you need to do that on a daily basis. So I think there will be cases that despite your best effort, things are not working out. So in such situations, you have to intervene, bring other talent into the picture. As I mentioned that, they're trying to solve a particular problem. Maybe they have a weakness in technology. Sometimes a founder leaves the company, and creates a gap. So that's another issue that happens. So those things you have to track on a monthly basis and see whether some major issues are happening. When the MIS comes on time, we set a date that every 15th of the month, your previous month MIS should be there. If you start seeing that MIS dates are missing, so that means something is not right. So they're not able to even report to the investors on time. So these are early warning signals. And you then start asking more questions, what's going wrong, what's happening in the team, and that's when you start going deeper, you narrow down to the problem and then help them solve that problem. But if you're still not able to solve that problem, then you have to take a call. How do you really handle that situation?
Right, and also you have touched upon a very important aspect. Like, there are some people who have many ideas. So for them, starting one startup, then selling it for a profit, and then starting another thing becomes a sort of routine work. This is how they see their growth as an entrepreneur. But Is it advisable, and how does it affect in terms of the sustainability of that startup? Have you seen such ventures last a long term, or it doesn't work?
So there are two things to it. If you're focused on the startup that you're working for us, we want our founders, our entrepreneurs to focus on the business that we have invested in. So that's why we always invest in people rather than in their companies.
Okay.
So effectively, if somebody says, oh, I have this company where I have a X% stake, and I have this another company, I have so much stake, that doesn't work with us. You have to be more than 100% aligned with that business. So that doesn't work. However, if you got an exit from the previous business that you were working on, and now you're looking to do your next business, now that makes a lot of sense, because there are lots of lessons learned. In fact, those entrepreneurs are actually preferred. In fact, we are investing in entrepreneurs. We have made 2 investments in our own portfolio. A company called I Can Heal. The founders are ex-founders of PharmaRack, a company that we sold to consortium of pharma companies in India. Another company that we invested in, Leica, which is a women's health platform. That's again an ex-founder who actually gave us a very good exit, a company called Exit Dental Labs. So these founders actually are proven founders. And we know them. We invested in them, worked with them, then they gave us good exits. So it makes very natural sense for us to work with them again.
Okay, now, in many startups, like I said, you start with one original idea, but then you also see a gap where you can expand. So for example, if I started with an idea and I needed you to invest 10 crores in my project, now I'm coming to stage 2, I want to expand, and again I come to you and ask for another 10 crores for investment. Is that seen as a healthy sign? Or is it a red flag that they don't know what's happening in the first, now they are going to the second branch of it? How does it work?
Flipkart started with selling books, right?
Yeah.
Same thing with Amazon. So I think if somebody had evaluated their business models purely on the basis of the potential of selling books, they would have made a wrong judgment about the investment opportunity. So the business will evolve over a period of time, right?
Okay.
As long as your core value proposition that you focused on, that remains intact. And that also can change. Various founders will pivot over time depending on how the markets are changing. This does happen in highly regulated businesses. For example, fintech. A new regulation comes. You came in as a P2P lending platform, and regulations change substantially where P2P lending platforms have to now follow certain guidelines. Your business model doesn't become viable anymore. So you can, then switch to a different business, leveraging what you created so far, and maybe move into an asset management business. So you have to evolve over time, also have to keep an eye on how the customer behavior is changing, how the market is changing. Technology also is changing, right? For example, you may have started using an AI technology today, but a year later, this technology has substantially got disrupted. So you have to keep changing. In fact, founders should keep an eye on what's changing proactively and change with the market.
I think that's a great point. Okay, I don't have much time in this session. One or two quick questions I would want to squeeze in from the audience. I have a gentleman raising the hand there. Can we please give the mic to him? The second table on my right. So please keep your question brief and sharp.
Well, thank you very much for very insightful session. Mr. Gupta, I would like to hear your opinion. It seems to me VC is playing the role like a father is playing for their kids, teenager kids. And startup founders are probably in that segment, So how do you handle the gen differences, and how do you basically, what all you do so that they get stabilized and tuned according to working on the wisdom which you are sharing with them? Thank you.
Yeah, that's a very interesting question. In fact, I have 3 kids, all Gen Z kids. Very, sometimes, it becomes hard to understand their thoughts, their ideas, and how they're looking at the world. So I think one is that you have to stay very close to your own kids and understand, what's changing. So I try to do that. I spend a lot of time with my kids. And of course, spend a lot of time with young entrepreneurs. Actually, you have to make sure that you understand what is moving and what's not moving, you know. So, you know, they're crazy about Acorn, for example. I mean, I didn't even know who Acorn is. And when I kind of looked a little deeper, I said, I should know about it. So I think you actually have to make sure that you keep pace with what's happening in their world, and things are changing, the kind of technologies they're using, the kind of games they're playing. That actually makes a huge difference. We invested in a company called Snitch very recently. It's a Gen Z product. And when I was looking at the product, I was like, you know, what's big deal about this? I mean, it's shirts and men's wear they're selling. So I was like, what's so big deal about it? And then when I got deeper into it, I realized that it's become a craze in that generation. And I realized that it's because the fashion is changing so fast, they want to see new designs every week. And that's exactly what the company was doing. And they were adept at that.
Right.
So we invested in them, and that was the right decision for us to do. So, you know, absolutely the right thing.
Thank you so much.
All right. You know, there is a second part to this particular session that we are having right now from Mr. Vikram Gupta. We've had the talk on primarily the startup's point of view, but what is an investor's point of view, we will discuss in the second panel discussion that's just lined up after this. So maybe you can keep your questions for that also. Thank you so much, Mr. Gupta, for a wonderful session.
Thank you.
It was a pleasure talking to you.
Thank you so much.
Thank you.